Hello my fellow freedom builders and welcome back to the channel. Today it is finally time for a stock of the week, and the reason that I say finally is because there's been a lot of videos I simply needed to make about the coronavirus and the little stock market crash the last couple of days and so on. So there has been some urgent videos I needed to get out, but now it is time for stock of the week, and this time we are looking at Unitedhealth Group. By the way, if you haven't done already and if you would like to see more of these kind of videos, remember to subscribe to the channel, hit the like button down there and the bell notification to make sure that you get notified every time I put out a new video. That is 2 to 3 times per week, so there is plenty to see. Alright, Unitedhealth Group. If you are seated in United States, I'm pretty sure you have met this company in some way. You might also have, if you are around the world, they are located in or have businesses in 130 different countries, I believe it is. And today we're going to look at both some of the fundamental parts. As you know, I am looking at the qualitative fundamentals. That is pretty much everything about the company besides the core numbers. I'm looking at the numbers, some dividends, what the insiders are doing, if it is a good value stock, looking at some short term, and of course at a price chart. And if we start out by looking at their website, they have these two different legs, where one is larger than the other, measured in revenue, but they're pretty much 50-50 in their earnings. That is close anyway. One of them is the Unitedhealth Care, and that is the one that I'm pretty sure you know if you're seated in United States. That is the entire state Medicaid community programs, employer-sponsored health benefit programs, and so on and so on. They are very, very large in this program niche. And they are sitting on, I think it's about 26% of the entire market for these services in the United States. So that is one part of it, and that is huge in the United States. And they have something like 300,000 plus employees if you count everything with. So that is a really, really large company. The other leg they have is the Optum. And that is more of a platform-based part of the business, but that is growing very, very quickly as well. And it is just 5 or 6 years ago, it only was around 20-25% of their revenue streams or their earnings that came from the Optum. But now it is up around half of their earnings. So it is growing, and they are focusing a lot on this Optum platform also because that is the easiest part to push out to other countries to sell there. You can see they have population health management and health care delivery. They have a lot about information and technology. And then they run a big, I think it's a software platform, something called the Optum RX for pharmacies that can be used all over the world. So they are in a niche that will definitely have customers pretty much forever. However, there is some fundamental stuff here that we need to have a look at before we look into the numbers. And that is the political side. And that is actually one of the reasons, if we just take a quick look at the charts here, we can see that they have had a very good upturn here. But then it started to decrease in price from around 283 and went all the way down to 200. And one of the reasons can be found here. Because it is an election year, and one of the candidates that seems to be getting ahead, at least among Democrats, is Bernie Sanders. And Bernie Sanders wants to make all of this healthcare niche into a government-controlled thing. And I'm not here to talk about politics, so that is pretty much up to you if you are for or against that. I can say I live in Denmark where it is government-controlled, and that works pretty nicely. But I'll not be the judge of what other countries should do here. I can just say that the market became nervous about these healthcare stocks when they could see that Bernie Sanders and a couple of the other Democrats as well started to really get some speed in their campaigns. If it seems when we get close to November, if the polls shows that Donald Trump will win for sure, then I think the Unitedhealth Group will increase very much in price, because as far as I can tell, there's not, even though he is saying that he wants to do something about this healthcare packages, then there'll definitely be less activity here than if Bernie Sanders comes into power. However, even though Bernie Sanders win, I have a hard time imagining that he can get a complete health reform through both Congress and Senate. When we saw how much trouble Obama had, and he had a complete majority the first couple of years, as far as I recall, and even he had a hard time getting this health care reform through. So there are Democrats that are opposing it. So even though Bernie Sanders or one of the other Democrats should win the presidential election in November, I actually don't see that Unitedhealth Group should be severely hit by it. But of course, insecurity in the market can put a bit of a stop to the stock price increase, definitely. All right. So let's have a look at the different aspects that I'm normally looking at. And first of all, if we are looking at here, just some of the numbers. We have Unitedhealth here. And from Stockopedia, you know, I usually use Stockopedia, one of my favorite tools. They have this very quick summary up here where we can see that the quality of Unitedhealth Group is 73. The value is 50. That is not very high, but that is a bit due to the price increase over the last couple of months. The momentum is great, and the overall stock rate is 87. So if we dive a bit into these numbers, we can see here that they have a PE ratio that is a 12-month forecast rolling at 16.5. That's a bit average towards both the industry and the market. The PEC ratio is actually quite nice, 1.3. As you know, I do like that below 2. Here we take the price earning right now and divide it by the estimated growth in earnings per share, and we get the 1.3. telling us that we are actually not paying an obscene amount of money for future growth here. So that is quite okay. Earnings per share growth estimated, quite nice. And dividend yield, I'll get back to that later. What do we have down here? We have price to sale around 1, that is okay. And an EV to EBITDA around 13, that's okay. The numbers down here, of course, gives us a good quality in the overall score. That is a return on capital at 11.3, return on equity here 25%, and operating margin. And that seems to be going up, the operating margin, but right now at 8.13. And as we'll see in the estimates a bit later, the price earning is going up a bit, but that makes actually okay sense, because if the margins are getting better, then that justifies a bit of a higher price earning. The Petrosky score is 6. That is okay. If we're looking down here at you can see down here in the graphical history and the estimates, everything is pointing up as we like to see here. And the 2021 earnings per share estimates is also tipping up a bit. There's 29 brokers covering this, and they are up just around a strong buy. So already here we're getting an idea that we are sitting with quite a good and solid potential buy candidate. But let's dive a bit deeper into it even more here. We have the earnings per share growth. As you can see here, the growth hasn't been kept up around the 30%, and that is almost an insane amount increase every single year. But if we see the earnings per share normalized here, this is what I like to see in a graph. That is just a steady climb from left to right. Looks very, very good, and the estimates are also quite nice actually. If we are looking down at the cash flow, There's not really anything to say about this as well. Just growing. The capex, the capital expenditures, are going up a bit. But as we can see, the free cash flow, what they are sitting with, how much cash they have in their hand per share each and every year, is simply just rising and rising and rising. Dividends per share, for those of you that are focused on the dividend, then you can see that it is growing quite nicely here. And that is also the estimates also that it keeps growing. It's not that they have an insane dividend yield. That is about 1.5% here. That of course will go up a bit if the stock crash right now. I'm not sure you can call it a stock crash, but at least the downturn in the market. If you can buy Unitedhealth Group at let's say a 10 or a 15% discount, then of course you will get a higher dividend yield as well. What I do like is that their dividend cover here is very nicely above 2. That is how many times the earnings per share can pay for the dividend. And it seems here that the earnings per share can pay 3.5 times for the dividends. And you can also see that they're paying out dividends per share. They're paying out around $4, and they're sitting on $17 in free cash flow. So there is absolutely no problem in paying the dividends. And of course, one thing that you should consider when focusing on dividends as a part of your investment strategy is, of course, if it is how secure is the dividend. I'm not buying a dividend stock because of the former dividend payments. I want future dividend payments. And if we can see that they can easily cover the dividends with the free cash flow and the earnings per share, there's not much to worry about there. I'll get back to the dividend yield just in a second. We'll just have a look at the net debt. That is going up, and that is partially because they are they're doing some acquisitions. That is in the pharmacy, in the logistical technical system part, where they are trying to expand. Also, so they are a bit more diversified away from just United States and this insurance system in the United States. All right, let's have a quick look at the interest coverage. They can pay their interest with no problem whatsoever. I promised you just to get back to the dividend yield, because that is here around 1.5 and 2 over the next couple of years. But if we take a look here at the Morningstar, as you can see, we have here the dividend per share, trailing dividend yield, and that is what we just saw here, 1.49. But then they have a buyback yield, so they're also buying back some of their own shares. And if you've seen my video the other day, I can link to it below, where I'm talking about shareholder yield. Then we are taking the dividend yield and adding the buyback yield and saying this is actually some of the things they are spending their free cash flow on. And when they are buying back their stocks, that can actually support the stock price from not going way too much down. If a crash is happening or if something bad is happening to the company, then if they have a good buyback yield, and that if it is based on some solid considerations, then that is actually quite nice to have that as well. That should be added to the to the dividend yield. So it's not just 1.5% you're getting, you're actually getting 3.2% almost. Although the buyback yield, you don't feel like you're getting them. And I know many of you want the dividend in your hand, feeling that you're getting a passive income. But in my way of seeing the world, the buyback yield is equally as good and should be considered together with the dividend yield. So 3.2% in current year, and that is actually quite okay for such a good company with such good growth, where you are getting more and more growth each and every year. All right. Let's move on, and we'll have a look here at Saks. And first of all, we can see here, of course, the price have gone up, and we can see that the 2021, the estimates for the earnings per share is also going slightly up, and that is what we like to see. If we look at the broker recommendations here, comes down here. Yeah, the broker recommendations. then that has dropped a bit lately. And as you know, I'm not too fond of these broker recommendation dropping. It is like they have found some sort of bottom here. But the reason, as far as I can tell, they were up here at a very hard buy. And right now they are at 1.5. That is also a buy. I think that is a strong buy, and around 2 is just a normal buy. So they are still at buy or strong buy, the analysts and the brokers here. But the reason for this drop is, as far as I can tell, the whole election issue with what do we do if a Democrat comes and say that this entire sector should be completely turned around. That is something the analysts are not too fond of. All right, if you're looking at the price and consensus here, let's just have a look. That is the one we looked at a second ago. Sorry, that was the price and earnings per share surprises here. If we can get that, yes. Here you can see, as we usually do, we're looking at if we have any earnings per share surprises, and they are surprising practically every single time they're coming out. They have earnings per share surprises, and you can see it's green all over, and that is what we want to see here. All right, let's have a look at the Guru Focus. I have not really mentioned this before, but in Guru Focus, they also have a ranking system. It is not one that I normally look a terrible lot at, but let's just see here, if we are pressing this one, they have this 5-star system. And in that, they have done a lot of numbers crunching, and the companies that they are giving 5 stars, they are gaining on average 12.1% per year. And as you can see, percentage of stocks that are still in loss if held for 10 years, there are only 3% of these 5-star stocks that actually show a loss after 10 years. Whereas you can see when we get lower and lower here with 2 stars and 2.5 stars, there are a lot more of these stocks that are losing money over a 10-year period, and they are on average gaining less and less the farther we get down here in the number of stars. So this is a 5-star company in the Guru Focus, which is kind of neat. The severe warning signs, I also always like to see that. And they have an asset growth faster than the revenue growth. And what does that mean? Well, it means that since they are acquiring other businesses and so on, they are we saw that on the net debt as well. They are acquiring a lot of businesses, and that means that their assets are growing and the revenue hasn't really caught up yet. It says here, if a company builds asset at 14.6% a year, which they do, faster than its revenue growth at 13.1% in growth over the last past 5 years, it means that the company may be getting less efficient. I'm not really seeing that here. I am seeing that the margin is rising. They're rising. You can also see here revenue per share, consistent growth, operating margins. There is an expansion. So this is not really something I would be concerned about, actually. All right, let's have a look at the shorter time frame. And here we have the tip ranks. And when we are looking at what the analysts are saying here, as you know, I'm only taking 4 and 5 stars analysts here because I don't want all the analysts that are not really performing. So I want the analysts that actually have something to say that makes sense. And we can see over the last month we have had a lot of buy, a couple of hold signals here, but price targets over the last month somewhere between 330. We have a 304 here. And then up to 362 7 days ago. And if we look at the current price, it is only at 277. It had quite a large drop yesterday during the overall market turmoil. So if we should up to 330, that would be around 20% actually that there was an upside potential here. So that is actually quite okay. If we look at some of the others here, overall it is an 8, and that comes from the analyst rating, which is a strong buy. the bloggers. And the bloggers, you can see there are a lot of bloggers there from Seeking Alpha and Investor Place and Fool.com and so on. And they are quite bullish. We can see that the hedge fund activity is increasing. Insiders are selling a bit, but it is not really the big insiders. If we are only taking the 4 and 5 here again, and we can say that we can pick a bit which insiders we want to see. But as you can see here, the big cannons in the company, they are pretty much buying all of them as far as I can tell. And yeah, there's not much to say here. It is small potatoes, and it's not really something that matters. It is not one CEO or CFO selling 10 million shares or something like that. That might trigger us to worry a bit. Otherwise, tip ranks investors, very negative. I'm not looking too much into that because they are basically retail traders like probably you and I, and retail traders do not have such a good history of telling which way the stock will go. News sentiment is very bearish. If we look at that, what kind of news stories are in here? That is something about the overall indices. US shares lower a close of trade. That is the Dow Jones falling quite a lot and so on. So it is not something very company specific. You can see Unitedhealth, American Express share losses, lead Dow's 862.4 and so on. But it's not something, it's not news about United Healthcare getting hit by some overall policy changes or something like that. But you can see here, 17 hours ago, United Health stock plunges towards worst day in nearly 9 years as Sanders Nevada wins stokes investor fear. And that is this Bernie Sanders fear that I'm talking about. But to be honest, if you want to buy United Health Group, I'm not really seeing that this is a big issue. And if you want to buy it, if you want some better value for your money, you might want to wait until Sanders get even better results and better polls. That might send the stock down even further, and you might have a good opportunity to buy. All right, so but nothing in here that really concerns me. Then we can look at the value, and as you know, I tend to look at fast graphs, which let's just zoom out a bit here. Yes, we have it here. And as you can see, we don't have the latest drop in price. I think this is only taking each and every month. So in a couple of days, we should get a new price indication where this has dropped a bit down to the 277 where it is right now, maybe even further. But that doesn't really change this picture since this is a multi-year focus. And what we're seeing here is that over the last 12 years, well, it's actually only 10 years because then there's a couple of years out in the future here. So over the last 10 years, we can see an earnings and a PE ratio lines that are correlating very well here. And they have an average adjusted operating earnings growth rate at just below 15%. That is very nice. However, what we can see right now is that the price has shot up and is quite a lot farther up than the trend here, which could indicate that we should back up a bit or the price should pause a bit. You can see that if we were buying the stock, we can zoom out even more here on 20 years. You can see that there's a definite tendency to buying a stock that is in an uptrend, but buying it in a value area and holding it up to some point where you think it is overvalued. You can see that you can actually buy the stock and get an annual return on 26% here. I know this is an easy case because everything is going up, but it's just to say that if you bought it when it was very overvalued and held it for something like 10 years here, let's just have a look at it, you would only be making 7% because you bought it from a very expensive point regarding the earnings. And I know that I am also a technical analyst, so I am looking at trends, but it is just there are so many stocks to choose between. So why not choose the stocks that are in uptrends, but are in uptrends coming from very low price points or value points here. So what I'm saying here is that right now it seems, at least here, 20 year turn, we are quite in the overvalued. And if we zoom down into the 10 years here, we were also in overvalued. We could see that the price growth, or the earnings growth, sorry, were just about 15%. If we're going down further, we are only seeing 5 years, and it seems like the growth in earnings are picking up, and now they're just below 19%. And at this point, this is actually not a terrible place to be, not compared to a lot of the other stocks I'm looking at, where in the overall market, I went through the entire S&P 500 the other day here in Fastgraph, and the vast majority of them, something like between 400 and 450 of them, are way below their earnings lines here, and I could only find something like 50 or 70 of them that were down in a reasonable value area. So this is actually not too bad, and if we are looking at the forecasting, we can see here that at a price earning around 19, a stock price around 298, we know that this one will have dropped down a bit, down to around this point, which is actually even better. But even at this point, around the 300, if it can keep its price earning, and I think they can because of their margins going up. Let's see if we can make this one. We can see that just from this, actually even a bit lower price earning, we could go to 321 in about a year. That would give us a total annual return on 9.3%, including the dividends. And if we follow and say that the analyst, and we are down here 25, 26 different analysts thinking out 2 years in the future, we can see that if we just hold the same price earning, we go up, have around 13% per year included dividends. That's okay. What about if we want to hold it in a couple of years and it drops a bit in price earning? Well, we are still in the positive. What about here when we drops down to a price earning at only 16.5? We are still in the positive. What if we drop all the way down here to a price earning at 15 from around 19? Then we are still barely losing money, 1.3% in minus over a couple of years. This is per year, of course, but this is in a quite bad scenario where the price earning drops and probably also the entire market drops, and maybe Bernie Sanders wins and he comes out and says that this should be completely reformed and he has a vote to do it. That might have this price to drop. But we are around 300 now, and even so, it would only drop to 284 with the earnings estimates that we see. So basically, this is not too bad. It is not 30, 40, 50% upside. But of course, if they can raise their margins even more and the investors and the markets are happy, I showed this before. Of course, we could also see a price earning that went even further up, and if we could get up to around 21 and the estimates in earning held through, then we would see a total annual return of around 17.5%, 18%. So that is actually not bad at all. The last thing, let's look at the price chart, and let's just take out the the weekly charts here. I like to zoom out a bit here and see. We'll just remove this one. If you remember, I am looking at two different things. I want the overall, the stock should do better than the overall market here, and the RSI should show us that we are actually in an overall trend. So what does this show us right now? Well, it is doing better than the overall market. We can see that it is running faster than its two moving averages here. If you want to know more about this strategy, look into the playlist on my channel here, where it's a playlist set called Learn My Strategy, and here I describe all about this strategy. It's quite simple actually. I want stocks that are in an uptrend. It is still an uptrend even though it dropped a bit yesterday. And it is doing better than the overall market. It is also resting on some seemingly strong support here. We had support here in 18 and 19 and in 19 again. We dipped down to test it here. And well, it will be exciting to see if we can drop all the way through it here. Even though it does, it might actually still be an even better value play if you are into the bit longer term here. Now you might say this technical analysis and support and resistance, is that really something that works? Well, it does, and my experience is that when we're looking at the weekly chart, it is actually working even better than at the shorter time frames, because the shorter time frames there can be a lot of manipulations and so on, but here it is very clear that there are some large market participants that is pushing the price down from around this 270, 280 mark. And when it really can work its way through this and bounce on this area, it shows us that there has been a shift in market sentiment as to Unitedhealth Group here. So I'm actually quite interested in this stock. My verdict here is, when I started to research this, the price was up here around 306, and that was actually at a point where I thought maybe it is a bit too expensive. But you know from the fast graph here that even from that point we had some decent outlooks actually. But if it could drop down without actually starting a downtrend, but if it could drop a bit further down here, as it did in the 200 in the late 270s here, or maybe even down to 260, we could have an even better upwards case, and I would actually be quite interested in having a look at getting Unitedhealth Group into my portfolio. I would, of course, monitor the entire Bernie Sanders political, the presidential election thing, because that could send the price down. But this is one of the stocks where I am sitting with my end conclusion here is that we are sitting with a very solid stock. They are growing on all the right numbers. Their margins are growing. They are diversifying into new markets, so they are not so dependent on the US policy makings. And as far as I can tell, they are run very, very effectively. And they are in a market that is just growing and growing. The healthcare, the health insurance, they're getting more and more old people in the world, and so on and so on. It is a service that we need. It is a sector that we need and that we're going to spend more and more money on. So the question in the United States, of course, is the political part. But I think that Unitedhealth Group is having quite a nice future. And if we can get the price down here and still keep our uptrend, but keep it, get into the stock around between 260 and 275, I think there's a very, very good upwards potential. I should mention to those of you, I can actually see here, just a second. Yes, I just went over to Stockopedia. I can see that they are, the fast graph and the Stockopedia, they do not agree completely here, because the Stockopedia tells us that the estimate is that the dividend will keep going up, whereas when we look at the dividend line here in the fast graph, it actually tells us that it would drop a bit. I'm not exactly sure why that is, but there might have come some new numbers. I'm not sure, but I'll look into it. Anyway, I am not into this stock purely for the dividends. I am in it for the overall earnings on my money. And in here, I can only say that Unitedhealth Group is a stock I could consider taking into my portfolio over the next month or two. That's all for now. If you have any comments, any questions, please feel free to put them in the comment sections below. Remember to subscribe to the channel and all that, hitting the bell notification and so on. You know the drill. All right. If you have some comments where something I have something I didn't see here, please also comment them. I'm not an expert in each and every company that I research, but I get quite a good overview. But if you have some information that I simply have overlooked, please feel free to write that as well. That's all for now. Take care of your money out there. I'll talk to you again soon. Bye for now.